Good morning, everyone. It's a great pleasure to present the seminar, the first seminar, Rio de Janeiro State University and Institute of Advanced Legal Studies, Dividends Tax Seminar. This is one of the activities included in the Brazilian International Taxation Research Group that I lead at the Law Faculty of the Rio de Janeiro State University. Unfortunately, this year we couldn't make the seminar in the UK as usual. This would be the third seminar coordinated by Rio de Janeiro State University and IELTS. Nonetheless, we have a great speaker to participate of the seminar this year. We have the great pleasure to present Professor Jonathan Schwartz, from barrister at Temple Tax Chambers and coordinator and professor in international tax law at King's College London. Professor Ana Paula Dourado from the University of Lisbon and member of the European Tax Law Professor. Professor Ana Paula has integrated many committees, many research groups regarding international taxation, and are leading seminars in partnership with European universities as well. I have the great pleasure to present Professor Lieselot Cana, professor of the University of Vienna and chief auditor of the Chilean International Revenue Service, and my dear friend Pablo Barreda, professor at the University Pontificia Comillas Madrid, where I have the great pleasure to make my PhD. So I would like to thank you, Doris Cunning, that was the organizer of this seminar with me. Doris will be speaking with me about Brazilian taxation of dividends, regarding issues about the classification of interest and dividends, considering the Brazilian juros sobre capital próprio, that is the interest of net income. And then we are planning present this seminar in two panels. The first panel will be compounded by me, Doris, and Professor Lieselot, and the second one will be compounded by Professor Jonathan, Professor Ana Paula, and Professor Paulo Hernandez. Our intention is to comment the United Nations models in the first part, using Brazilian case law and Chilean case law to illustrate the difference between the United Nations models and the OECD model convention. And in the second part, we will have the presentation of the EUCA issues regarding dividends with Professor Jonathan. Professor Ana Paula will explain about issues regarding the dividends and tax abuse in the European Union. And Professor Pablo will make comments regarding the Spain approach regarding taxation of dividends as well. So first of all, thank you very much for accepting the invitation. It's a great pleasure to host all of you today. For the Brazilian students from the Rio de Janeiro State University, it's a unique opportunity. We have all of you are experts in international taxation, and the possibility of integrate professor like all of you in this events, it's a fantastic opportunity for Brazilian students understand how dividend is treated in the UN approach, in the OECD approach, and now in the UK approach that is not in the EU, but is an OECD member, and have many interesting specific points in their net tax street network. So, Professor Lieselot, the floor is yours.
Thank you very much, Marcos, and it's a great pleasure to participate for the first time in this event. I'm very happy to be invited by my dear friend Marcos Livio. So let me just, the idea on the first part of the panel is to sort of, as far as what I thought at least, is to talk a little bit about different models and different dividend type of taxation. So I will try, first of all, to explain a little bit of what the Chilean tax system, I have it here. Let me see, can I, are you looking at this now?
Yes.
Good. Then I should go back because it's the first. It's just to give a little bit of background, and I think it's quite interesting in the sense that you have, you know, different systems, and we all need to fit in to, you know, negotiate in tax treaties. So what you have here, first of all, is a little bit of an explanation of how we in Chile tax dividends or distributions. So what we have is we have something called the first category tax, or business profits tax, because it really, for us, it's a tax on the business, on the corporate income, not necessarily the object of the, as a corporate, you know, we try always to explain that our system actually don't tax the entity. In the end of the day, it taxes the individual owner in different stages. So first of all, it taxes the owner of the partnership or the company or, you know, the corporation when it is earned. And that is what we call the business profits tax or the first category tax. And then we give a credit for that income, for that tax, sorry, paid against the personal income tax on the individual when he receives the income, or when it's distributed to the non-resident taxpayer. So this is the system originally. It's been like that for 30 years. A couple of years ago, it was changed, and we don't give 100% credit now. But for the purposes of today, I will use the 100% credit anyway, because you do get 100% credit if you have a tax treaty. What's the benefit with this system is that you don't have any economic double taxation on business profits. So that is the fundamental idea behind this idea, is to have no double economic taxation. It's only taxed once in this hand of the owner. So the withholding tax, and what we call the impuesto adicional, applies to payments of income to non-residents, this obligation is to be withheld at the local entity level. The rate is 35%, and we have different rates for different type of income of withholding taxes. But if we talk about dividend tax payments, it is 35%. So this is a way how we deal with it. This is the profits tax, that impuesto primer categoría. The corporation's taxable income is 100. The business profits tax 25%. This is for my example, because we have different levels of depending a bit of the entity now. Become a little bit more complicated, the system, as all systems become more complicated. So what we have is 75% net for distribution. So I'll just carry on. And this is why I wanted to use these slides, because it's slightly difficult to explain it without slides. So the net distribution is 75. And what we do is we add back the business profits tax paid, 25. So we basically gross up the net payment. So let's just assume for purposes of the example that we are now distributing all the income earned by the company. So they will receive in the end, as you see at the last line here, 65 and 35 will be paid in taxes. That tax will have been paid in 2 stages. First, at the level of earning the income and the level of the withholding by the local entity. If it's a corporation, if it's a sole owner, or whatever entity is, it has to withhold that business profits tax, but it's not a tax on the entity, and that's the important thing. So the tax there is paid at 25%, and then the withholding tax is 35%. So against that withholding tax, the additional tax, we would give a business profits tax credit of 25, and the tax paid at the moment of remittance is 10. In the end, as you see, it's been paid in 2 stages, but the person that's paid it is always the owner. Yeah. So the owners sort of have this. We have these ledgers where the income taxes paid during the year, if what type of income it is, exempt income, the date it was paid, etc. So it is basically on a first time, first out basis. So if, for instance, in this year, there's no payment, the tax, the 25%, will be recorded in this ledger. And when that income is distributed, the tax will apply, so that it will always be the tax applicable at the time of earning the income. So if, for instance, the tax goes down to 10%, it doesn't matter, because first we'll be having you're able to use the 25%, and then the next year you will be able to use the 10%. So what does this mean for Chile when we negotiate our tax treaties? Well, of course, it doesn't work at all. And now I come to a little bit more of what we're looking at today. The thing is, as you probably all know, the tax article in our dividends articles in our treaties, both models, UN and the OECD, applies to the classical system, whereby you have double economic taxation. It's one tax on the entity and one tax on the individual or owner, or whoever gets the distribution at one point, especially if it is a payment cross-border. So and the withholding tax applies. So what does this mean for us? Because if we had applied that to our system, our withholding tax, which is basically our corporation tax equivalent, but it's not the corporation tax, it's a tax on business profits, would have gone down, because the withholding tax would have gone down to probably 5 or 10 or 15%. So then, we would basically have lost out and we, our counterparts would have had a first charge as a corporation tax, which we don't have. So what we did was different options, but in most cases we have something like this, and I just put this is what we call the Chilean clause, and this is the Chile-UK treaty. So it basically says that the additional tax as the withholding tax, but here we use the word translated from Spanish, so we just translate the additional tax, which is basically withholding tax. If the first category tax, remember the first category tax is the business profits tax, it is no problem to apply the rate that we have as an additional tax, as long as it's fully creditable. Yeah, so just let me go back here. As long as this 25 is fully creditable and against that additional withholding tax, we can still apply it without limit. And that is the general rule we have in all our tax treaties. Now, together with the United Kingdom, with the UK, we also put a top on it, as we did with Brazil. Both cases, we put a top that rate could never be above 42%. And then, we would go back and renegotiate the tax treaty if the additional tax or withholding tax rate would be more than 35. So that was a little bit on how we insert ourselves in the models and the systems we have. And just a couple of short comments on the models, because I don't think the big differences between the UN and the OECD model here. Some of the things perhaps, well, I mean, it's obviously the UN model still has Article 14, so that will be part of Article 10. In paragraph 3, there are some other, well, in paragraph 2 as well about partnerships. I think that the OECD model has taken away the word partnerships, which I think is a good thing, especially for us. I think the idea of having partnerships is difficult, because we, in the end of the day, to talk about an entity that only exists in common law systems, personally, I think it's much better to talk about entities that if they are paying tax or not, transparent or non-transparent, or whatever you want to call them. But to talk about partnership when we have such a huge variety of them, it is difficult. So in that sense, I prefer the OECD model to the UN model, who still has as an exemption the partnership. Now, paragraph 3 also talks about corporate rights, and I thought I'll mention that this is something that both models have. It's something that complicates a little bit, because if in our sense that we have social rights in some of our type entities, and we sometimes need to take away that word corporate, because as I said originally, we do not tax the corporation itself, and we don't have corporate rights in some of our entities. We have social rights. These are basically, and I'm sure that Marcos and Doris can confirm that, but I'm quite sure that they have entities as well where there is another type of right and not necessarily corporate rights. Now, the other things that with the both models is that, of course, they have now the anti-abuse, the 360 days, 65 days of holding, the rights before you can apply the lower rate, which is, of course, an anti-abuse provision that both models have incorporated. The other thing that is perhaps slightly different, but they both use the same complication in my view. And in Chile, when we negotiate tax treaties, we basically limit paragraph 3 of the definition of dividends. We don't go through all that due sands or mining rights or whatever. We think it's sufficient to say income from shares or other rights, and there shouldn't really need to be such a huge list of different types of shares, because it might, we don't all have the same, so it's better to have some generic terms for it, in our view. The difficulty, and here the models are the same, is that they use not being debt claims, of course, and that is something that we pick up in our treaties as well. And we clearly established that there's no, when you have a dividend, which is a part, which is basically an interest payment, because sometimes the dividends have a minimum participation in the dividend, so to speak, that is a guaranteed interest payment. So all these complications both models have, unfortunately. We have, in that sense, with the debt claims, what we have picked up the wording in the commentary of the OECD, and we insert that in our treaties to make sure that the line between an interest payment and a dividend payment is clearer. Now, I'll leave it at there, Doris, and to pick up, and I'm happy to comment on anything else that you want me to talk about. But I thought that would be a sort of good introduction, and over to you, Doris. Thank you.
Okay, so I'm going to share our slides, and Professor Marcos will move forward. Okay. Thank you very much, Lieselot.
Certainly, in the end, we have some comments, and then we can participate all together in order to make the Q&A section more interesting. So I'd like to present Doris. In fact, I forgot to say that Doris is an LLM student from King's College. She was a student from Jonathan. She has a LLM in Brazil as well, a Master of Law. Doris has worked in many Big Four companies. She is a researcher of the Brazilian BEPS research group at the Rio de Janeiro City, and he's supporting many students at the Faculty of Law in Rio as well. So Doris, to be fair with you, I'm so sorry. Our presentation will begin with some remarks regarding the UN model, and then go into the Brazilian case law, just to compare how Brazilian tax treaties was celebrated, and in the end we can have our Q&A section. But just to note that at this moment we have 22 students from the Brazilian, from Rio de Janeiro State University, students from the LLM and PhD that are making the seminar with us. So dividend taxation in Brazil. Let's go. This slide is just to comment how the Brazilian tax policy is based on each kind of model. Brazilian tax policy on international taxation usually is based on the OECD tax model, but regarding interest, regarding dividends, regarding capital gains, we usually follow the UN model. And when we are treating dividends, the majority of the Brazilian tax treaties will follow this approach. Regarding the UN model treaty, usually it's a reproduction of the OECD model with the following observations. Dividends may be taxed in the state of the beneficiary's residence. Specific of UN model does not, however, provide that dividends may be taxed exclusively in that state, and therefore leaves open the possibility of taxation by a state of which the company paying dividends. Brazilian tax policy is following the source country. The majority of the Brazilian tax treaty is following the source country, authorizing the Brazilian tax authorities taxing dividends by when they are paying in Brazil. Regarding beneficial owner, the original UN model treaty article foresaw a beneficial owner as aspect included in the OECD model treaty in 1977. In general, OECD model convention restrict the tax in the source country to 5%. Nonetheless, Brazilian tax treaties following another kind of taxation. Usually, we have 15% using the source country principle, and sometimes 10%. In this case, particularly, Brazilian tax treaty is following the UN model, and then open the possibility for taxing dividends paid in a percentage over than 5%. And regarding timing thresholds, and considered BEPS Action 6, the new treaties that are being celebrated by Brazil are following the timing threshold of 365 days ownership in order to considering the taxation of dividends as well. Let's go, Doris, for the next one. What can be considered as dividends? Dividends for Brazilian tax treaties has the same definition of the OECD tax model. There is no great difference between the description of the definition of the Brazilian dividends to the OECD model. In general, it reproduces OECD model except the United Nations Convention when refers to a company performing independent personal service from a fixed base. In this case, we can't apply the payment of dividends. In general, Brazilian tax treaties reproduce Article 10, Paragraph 5 of the OECD Model Convention, except for the reference in the United Nations Model Convention to fixed base. So let's go to see the Brazilian case law, and this will be more clear to understand the Brazilian tax policy focus on dividends payments. The country is more socially oriented than UN in this tax policy. As I said, all Brazilian tax treaties using the test of the treaty or using the test of the protocol is source-oriented in order to facilitate, in order to permit the taxation of dividends in the source. Brazilian treaties most signed before 1996, when Brazil stopped taxing dividends, used a withholding tax of 25%. So since 1996, Brazil doesn't tax dividends anymore by the Brazilian domestic law. So the country had an interest in preserving its taxing rights, even have exemption of taxing dividends. Since 1996, Brazilian tax treaties wasn't modified in order to include an exemption to follow the domestic law. The situation now, by the domestic law, we don't tax dividends, and there are many examples of this treatment. As you can see, tax treaty with Chile is one of them, and all of them, including the new tax treaties that was celebrated but not yet in effect, with Switzerland, Singapore, Uruguay, and have a beneficial ownership clause like included. As I said, foreign withholding tax treaty rates usually goes on 10 to 15%. This is the general rule, and there's just one tax treaty with. This one is, Doris, can you help me with United Arab States? That the treaty is 5% if the beneficial owner is a government entity or one of the contracted states. This is an exception. In general, Brazilian tax treaties don't have this kind of exceptions, even treating with government entity. And in this case, we have just one treaty with this with exception. What are the conditions for consider a payable dividend? Only payable if company has accumulated profits. This is the general rule, or current year profits. Entering dividends from current year profit prior to the close of the year, for instance, should be agreed on the bylaws of the company. There is no restrictions imposed on the amount of dividend distributed to shareholders domiciled abroad. Even not taxing dividends, there is no restriction in the domestic law about the amount of dividend that can be paid. As I said, withholding tax is not imposed since 1996. though there are bills that seek to establish dividend taxation, the Brazilian parliament is discussing at the time being a bill in order to include dividends again, but the situation, the economic situation with the COVID-19 is impeding this kind, is not permitting this kind of discussion. Even Brazilian governments, the Minister of Economy, saying that he would like to have the taxation of dividends. Profit to be distributed as dividends should have already been taxed in Brazil for a corporate income tax. As Brazil has two kinds of income tax, we have to consider not only income tax, but also the contribution for net profit. We have a kind of contribution that is considered income tax in the scope of tax treaties. And this combined rate is about 34%. There is no other taxes in these dividends since 1996. There is no deductibility of this kind of payments, and the company can only pay dividends regarding the year's net profit, retained earnings, and profit reserve accounts. This is something that is really that is focused on accountability, and there are many considerations regarding income tax and accountability rules. And there is one more obligation, that is the registration of the foreign companies' participation in the Brazilian central banks. This is the way that the Brazilian tax authorities use for controlling the payment of dividends without payment of taxation, of income tax. Let's go, Doris, to the next one. The opposite situation has the payment of dividends. There is no participation exemption regime in Brazil. When a Brazilian company is receiving foreign dividends payments, it's for companies, the rate is 34%, and for individual, it's about 27.5%. Funds may be taxed at the level of the shareholders, it's around 15%, but subject to a case-by-case analysis on the type of fund and its regulations. Many Brazilian funds have exemption of the payment of dividends. And considering that Brazil has strict CFC rules, it's not recommended the use of Brazilian affiliation companies in Brazil. I think that this is the general rule. And now Doris will explain the juros sobre capital próprio, that is the Brazilian interest on net equity. Okay, Doris.
Okay, so I want to take the first minute to thank very much Professor Marcos Lívio for all the opportunity he gives me. I do my utmost best always to earn it and to make good use of all this trust and all these opportunities. I also want to thank Professor Jonathan very much. My international tax career had as an amazing starting point the LLM I did at King's College London, where I learned so much and everyone was so welcoming. And I miss very much those amazing lectures. So I'm going to try and be very short in my presentation. And also thank very much Liselot and Pablo, whom I've interacted with before in other seminars, for joining us again. and saying it's my pleasure to be for the first time in a seminar with Professor Ana Paula, a renowned tax practitioner who I'm having the pleasure to meet. Also thank Victor and the UERJ IT who are helping us with this, and everybody who is watching us, please feel free to interact in the chat, to make questions so that we can debate. The part that is with me is very interesting. It's the Brazilian interest on net equity. And the Brazilian interest on net equity, it arises lots of questions, especially when we're dealing with people abroad, because they say, what is this? And in this BEPS world that we're living in, this is a hybrid instrument, but it has a special characteristic because it's a hybrid instrument which was not created by parties. It was created by the Brazilian legislation in 1995. And back in 1995, the Brazilian economy was opening up to the world. So the interest on net equity, it does not have a tax intention. It has the intention of attracting investments to the country. So it is a specific type of remuneration for shareholders of a Brazilian company. Unlike dividends, it has withholding tax. So for regular jurisdictions, the withholding tax on remittance is 15%. For tax havens are foreseen in a Brazilian normative instruction, number 1037 of 2010. This withholding tax rate goes up to 25%. However, also unlike dividends, it is deductible. So you can have a tax benefit depending on your tax calculations. You can have a tax benefit of 19% or of 9%, depending on where you are remitting. Okay, because you will offset the withholding tax with your corporate income tax to be paid in Brazil. It also is not subject to the financial transactions tax, and it has limitations, also unlike dividends. So in order to remit the interest on net equity, it is interesting for the company to do some calculations and make a further analysis of its account. What are the limitations? It has one limitation on the long-term interest rate, which is given by the banks, and it must not exceed the highest of either 50% of the company's annual profits or 50% of the accumulated profits. So as you can see, the accounting analysis is very important also for the remittance of interest on net equity. As in dividends, it is also needed the minutes of the shareholders' meetings. It should have some corporate, there are some corporate indications of what should be done, such as bylaws, minutes of shareholders' meetings. It should be further analyzed. And the company there, and again, the central bank regulation in Brazil, as Professor Marcos said, it is very strong. So the participation of the foreign entity in the Brazilian company should be adequately registered in the Brazilian central bank so that there can be this control. The accounts to be considered for accounting purposes in INE payment are share capital, capital reserves, profit reserves, treasury shares, and accumulated losses. And this should be done, of course, by the accounting team together with the tax and legal team in order to verify how much should be remitted abroad and if it is possible and if it is interesting from an economic perspective for a company to remit interest on net equity to its shareholders. And what is interesting about this specific type of remuneration is it's, as I mentioned in the beginning, the hybrid nature. So is it a dividend or is it interest? We can spend days discussing all its characteristics, and I'm sure the decision will be half-half if we put up a poll. But the treaty protocols after 1995, when it was established, they state that the interest on net equity should be treated as interest for treaty purposes. So I give here a list of treaties signed after 1995. Chile, Israel, Peru, Portugal, Russia, Turkey. So there are many. And of the 4 treaties that we have in Brazil that are not yet effective, this is foreseen in the protocol of the Swiss, United Arab Emirates, and Singapore treaties. The exception to this rule of foreseeing interest on net equity as interest in the treaty protocols are Finland and the not yet effective treaty with Uruguay. And in this case, it is interesting to talk to a local tax consultant to see how the country is viewing the interest on net equity. This is very important for purposes of Article 23 and the offset of the withholding tax, and also for the purpose of the internal legislation of the company who is receiving it. This same rationale applies to the treaties before 1995, where we have Austria. Argentina was before 1995, but in the current protocol, it has already fixed this. So the current protocol with Argentina, which was updated in 2018, fixed this part of the INE being treated as interest. And other countries, France, Netherlands, Norway, Philippines, Spain. So the country of many of our colleagues here are foreseen here, have treaties with Brazil. And with this, I would like to thank you very much and return the seminar to Professor Marcos Livio so he can pass on to our next panelist who I'm looking forward to hear. Thank you.
Thank you very much, Doris. So for the time being, 27 students are making the seminar. For those of you that are making the seminar, you can send questions and comments to the speakers. It will be a great pleasure to interact with all of you. So, Liselotte, I have just one comment before giving the floor for Jonathan and Ana Paula and Pablo. When you were talking about the Chilean and UK tax treaty, you told something about, you commented something about agreements regarding percentage of incoming tax rates, 42%. And I couldn't understand. It is something about a MAP, a mutual agreement procedure, or which kind of consultation can you do outside a MAP? This is one of the questions that I like the design, but I couldn't understand the way how it can be done. And another question is, another comments regarding the Chilean tax policy. Could you say that Chilean tax policy follow the UN model as the Brazilian tax policy regarding empowering the source accounting when you are talking about interest, capital gains, and this particular income?
I was still muted. Now I'm unmuted. Thank you very much, Marcos, Professor Livio. Those are very good questions, and I'll try to answer them. First of all, perhaps the last question. I would say that Chile probably, in some cases, go further protecting source country rights than the UN model, and obviously more than the OECD model. And that would be probably the case of capital gains. We have been very successful in being able to maintain taxing rights at source for various capital gains, like, and particularly what we were concerned about was indirect selling of mining companies, because that was very frequent in our setup of ownership of our mining companies. They were owned by holding companies in various parts of the world, and we just wanted to make sure that we could tax those gains when they were sold. So we have been probably even more able to maintain taxing rights than the UN model in certain cases. And as I mentioned, the one important case which was difficult to negotiate, I must admit, was capital gains. And then in other aspects as well, of course, like services taxes, we have also been very successful. We have there used the UN model, but we took away the requisite, which is now gone away from the UN model, about being only applicable in Article 5.3b, the PE concept only being applicable to services rendered to connecting projects. So we took away that bracket. So in that sense, we also have slightly better source country protection than the UN model, I would say, because the UN model limited the service PE to apply originally from only connected projects. And that was taken away in the 2017 update. So now we are in line with the UN model, but that was because the UN model changed. I would say, Professor Livio, that those are the two important things that I think we have even gone further than the UN model protecting Chilean taxing rights at source. And regarding the first question, the system is a bit unusual. So just to sort of come back to try and explain a little bit what we did, is that our withholding tax is very high. You know, if we had reduced it in our tax treaties, which a classical system do in a negotiation, we would have been without any tax at the moment of remitting, because as we give a credit for the first category tax or business profit tax, or if you want to say the equivalent of the corporation tax, we wouldn't have been able to tax anything at the moment of remittance. And of course, this is never fair, because our system just applied a 35% total tax in Chile, staged in two parts, while most countries have, the subject of tax being the corporation tax, and then, the typical juridical double taxation of a withholding tax. Because our system is very different, we had that problem. And so we managed to convince our counterparts that we couldn't really limit our withholding rate. So if you remember the first part where I explained that as long as our business profits tax is deductible against the withholding tax, we are free to apply it. Yeah. So that is the equivalent of a corporation tax in a country which is not limited in a tax treaty. That's the country's sovereign. The corporation tax in the country can be going up or down. That's really up to the source, where the company is constituted to pay its tax in that country. Because we don't have that system. It could never be a fair negotiation. But what we agreed with our counterparts, and some of them have, all of them have that first part, and then some, and that's where I'm coming now to your point, Professor Livio, is the 42%. What we said is that, okay, the 35 is not fixed. It can go up and down, as well as any corporation tax in a country. However, if it goes above 42%, that article will not work anymore. And we will have to renegotiate the balance of the tax treaty. So the outcome, if we have raised our additional tax to more than 42%, would have been that the article doesn't apply and we have to do a protocol with that country. And as far as I remember, actually, I think we have exactly the same with Brazil. So it's in the protocol, and I think Brazil and the UK were two of the countries who we negotiated that with. And it was basically because those two countries were concerned that we would raise our corporation tax too much. And they wanted to have a balance. They were okay with the 35% because that was more or less what they would charge in total, with a 25% corporation tax and a 10% withholding tax. The difference here, and you saw that with my example, and that's why I wanted to have a slide on it, is that we pay the withholding tax on gross. We don't pay it on net. So that means, again, that this is the same entity that's paying the tax. It's just paying it in different stages. And I thought it would be interesting for you to you know, it's just to shows that we all have different system. That system, our system, of course, does away with double double economic taxation. And it was actually invented by economists who thought that that was the way it should be. So thank you for those two questions, Professor Livio, and I'm happy to take any questions from other professors or the audience. And by the way, Professor Schwartz, I was 50% of my LLM in the London University was at King's College, but that was before your time. So you see, my hair is gray.
So we have few more minutes. If the speakers want to make any other comment, please feel free to do that.
Well, thank you very much. Hi, everybody. Thank you firstly to Doris and Professor Marcus for the very kind invitation. It's wonderful to be with everybody and to have this opportunity. It also is very gratifying as a teacher to see a former student like Doris making a successful career in tax. Gives me huge pleasure. There are also a number of King's International Tax students participating today. So I hope that they're going to find this as interesting and as stimulating as I certainly am. I thought that where we should start is really with the basic question, what do we mean by a dividend? So if we look at the next slide, or the next slide after that, I thought we might just start in the middle, some things that you've already seen this afternoon, and this is the definition of dividends. I've chosen the Portugal-UK treaty between the two former colonial powers, because there's no treaty between Brazil and the UK. And you'll see that it includes the language that Lieselot was talking about, which is pretty standard OECD and UN model language. But I think it's what is interesting is to see the last two bullet points, because the first, which deals with the UK treatment or classification of items as dividends, and that is that any item which is treated under UK law as a company distribution is a dividend for the purpose of the treaty. And I think that language, which is standard in UK treaties, is actually designed to get around the problem that Lieselot was talking about in interpreting what do we mean by corporate rights. So this simply says that whatever is treated as a distribution in UK law is treated as a dividend for the purpose of the treaty. And in a way, that is the important part of the definition. All of those other elements, I think, become considerably less significant. And then we also see a slightly different inclusion from a certain partnership distributions from a Portuguese perspective. And if we move to the next slide, I thought it might be interesting, because I'm always interested to know whether different languages actually mean different things in the treaty. But I think what is curious here is that there's actually a mismatch between the interests of the two contracting states, what has been put in to deal with specific Portuguese issue and what is dealt with for a UK issue. And they're actually quite symmetrical because the UK position is very comprehensive. The one from Portugal is in addition. And that, of course, leads us on to the domestic law, and the UK domestic laws on the next slide. What is a dividend in domestic law? And there we've moved away from the word dividend as our general category. Instead, for corporate tax purposes, we talk about distributions, but it still goes back to this more old-fashioned language, talking about any dividend paid by a company, including a capital dividend. And then we have a number of items that, for corporate law purposes, would probably not be regarded necessarily as a dividend or a distribution. So any other distribution out of the assets of a company in respect of shares. So that is a very broad category. And you can see that if the shareholder doesn't give anything, then more or less anything that they get from a company is likely to qualify as a distribution. And then, although this is in very summary form, because if you look at the legislation, it goes on at, sorry, if we can just stay with that one, Doris. There are a number of situations where interest payments are treated as distributions. And so we've got quite detailed rules that will classify some interest payments as distributions and indeed some distributions as dividends. So it is not a straightforward, intuitive area, rather one governed by very detailed legislation. And the other thing that's interesting, and that is that in certain cases where debt, in other words, there's a bond issue, for example, debt instruments are issued or shares are issued by a company, that can also give rise to a distribution in some situations. So very, very wide category of items that will qualify as a distribution for UK domestic tax purposes. So if we can then move on to the next section, and I thought it might be useful just to look at a little bit of history. And the reason that I wanted to do that is because the UK system of taxing dividends has changed many, many times over the years. And the reason for this, of course, is the tension between trying to eliminate double taxation, economic double taxation, that is, at the corporate and the shareholder level, because there is only one level of profit, as Lieselot has said. But ideas about that have changed many, many times. And since we've only got a couple of hours, I thought it might be useful just to look at the most recent system, which no longer exists, and which was an imputation system. And it was really quite complicated, and this is essentially a summary of it. So firstly, a company paying a dividend had to pay so-called advanced corporation tax. And what that was a prepayment of the company's corporate tax liability. So at the end of the year, when they work out how much tax is paid, they can use any of this advanced corporation tax that has been paid to satisfy their liability for that tax. If there is more ACT, then it could be carried back to a certain extent, or it could be carried forward. In addition to that, if there was a surplus of advanced corporation tax, it could also be moved by the company that had paid it to other members of a corporate group, or indeed to a consortium or a joint venture. So there's quite a lot of flexibility as to what you could do with that tax. But the one thing that you can see there is you couldn't get it repaid. In addition, when dividends were paid within a UK group, so to a UK resident, a parent company, it was possible to elect not to pay advance corporation tax. And the idea there was consistent with eliminating economic double taxation, because as long as it stayed within a corporate structure, it was not subject to any tax at the shareholder level. So what happened at the shareholder levels? So firstly, individual shareholders were entitled to a credit to offset the income tax that they had to pay on the dividend. In other words, it's the tax that the company has paid is imputed to the shareholder, and that offsets their liability to income tax on the dividend. If you were a non-taxable UK resident, so for example, a pension fund, then you could receive cash paid out by the tax authority equal to the amount of that imputation credit. So the effect of that would be that the profits, for example, of a company owned by a pension fund would, in principle, not be liable to any corporate tax. And that is designed to reflect the theory that actually the company is just a proxy for the shareholder, even though it's a separate legal person. Now, the rates were such that it never worked absolutely perfectly, but that is certainly the theory behind it, and that is what Lieselot was talking about earlier. Now, Lieselot said when she started that it doesn't work in a cross-border situation. And this reminds me of when I was doing my LLM a long time ago at Berkeley in California, when imputation systems of this kind were very fashionable as the way to eliminate economic double taxation and were being adopted by many countries, particularly the case in Europe. And I couldn't think of a topic, like many students, for my dissertation. I didn't know what to write on. And my supervisor said, well, why don't you write on cross-border issues involving imputation systems? So I went away and I did a bit of reading, and I came to the conclusion that I didn't understand the problem at all, because it just did not seem to work cross-border. And I was convinced that I didn't really understand it at all. So I went along and I persuaded my supervisor that I should change my topic to something else, which I did. But I subsequently learned by following all the case law of the European Court of Justice, where the UK imputation system was gradually torn apart because it infringes EU law, to confirm that actually I did understand it and that it doesn't work in a cross-border situation. And the basic problem is that the company paying the tax is in one state, and the shareholder paying the tax on the dividend is in another state. And when it comes to sharing the taxing right between those states, there is no obvious solution. And so you can see that, firstly, the system of advanced corporation tax was abolished because it applied in a discriminatory basis to non-resident parent companies. There was similar litigation under tax treaties, which said that it didn't infringe treaty non-discrimination, but that didn't really change anything. And similarly, when dividends were received by UK companies, they still had to pay advanced corporation tax, even if the company also qualified for a foreign tax credit on that dividend. And the result of that is permanent double taxation of foreign dividend income. And again, the Court of Justice said that that infringed the right of establishment. Now, like Lieselot's very inventive clause to deal with these kinds of problems, the UK also came up with some experimental language in their tax treaties, which themselves were much litigated and gave rise to huge, huge problems in tax treaties. So some treaties extended the imputation credit. One of the cases dealt with the availability and whether that was required under the EU Parent Subsidiary Directive. And in addition, UK resident individuals did not get an imputation credit if they received a foreign dividend. So again, discriminatory under EU law. So I think that this illustrates that whatever the correct system is, if indeed there is one for taxing dividends, the imputation system was very, very imperfect, and the UK abolished it. So finally, let's just have a look at what the UK system looks like on the next slides. So this is looking at it today, but actually it was quite a long and painful process where the system gradually changed and became less and less coherent. So let's have a look at what we have in the UK. Firstly, if a UK company receives a dividend, it's generally exempt from corporation tax. So that eliminates economic double taxation within corporate entities. But we love complicated law in the UK, so we have 6 different categories of exempt of dividend, each of which has its own rule. In addition to that, companies can also opt to treat a dividend as taxable and claim credit for the foreign withholding tax on the dividend and an indirect credit for the underlying tax paid by the company on the dividend. So we've got 2 methods of eliminating economic double taxation at the international level for UK companies. As far as dividends paid by UK companies, firstly, ACT, which was illegal under EU law, has been abolished. Secondly, there is no withholding tax on dividends paid by UK resident companies. So that means that we only have one level of corporate tax in principle. So if you're a non-resident shareholder, whether you're in Brazil, where we have no treaty, or in Chile or Portugal, where we do have treaties, there is simply no tax at the shareholder level. The only exception to that is if the dividend payer is a real estate investment trust. There we have withholding tax, and the reason is that real estate investment trusts do not themselves pay tax on their income from immovable property, and the tax is only levied at the shareholder level. So relatively coherent system. Let's have a look at individual shareholders. So the imputation credit has disappeared. It's taken a while, and there has been a lot of double taxation of dividends. But what we have now is a special income tax rate set up for dividends, which is designed in part to reflect that tax has been paid by a company. But of course, that applies regardless of the rate of tax paid by the company, or if it pays any tax at all. So it's a very imperfect system. And then we also have an annual exemption, so you can receive a small amount of dividends free of income tax as an individual shareholder from these categories of dividends. So this is something that has no kind of intellectual basis. It's just evolved as the old system was effectively dismantled. Now, on the last slide, I'd like to just pick up another important issue, and that is that there are lots of different ways in which this economic double taxation is dealt with by different tax systems. And if you look at the case law in the Court of Justice in Europe, there is so much case law on dividends because everybody thinks that they've got a better way to do it, and they change and it still doesn't work. And one of the other ways, of course, that economic double taxation is eliminated is by treating entities as transparent for tax purposes. And therefore, there's only one level of tax, which is not at the entity level, but at the level of the member or the shareholder. Now, in the domestic setting, that is fine, but it creates huge complications in the cross-border situation. And in the UK, this is particularly true where we have distributions by foreign entities that are treated as transparent for foreign tax purposes. Most of the disputes come from US entities where companies can choose to be treated as transparent. And the problem is that as far as UK is concerned, a dividend is income from a share. And that is a separate source from the profits of a company. So the profits of a company or of some other kind of legal person are the profits of the company and not of the shareholder. And that means that the shareholder is normally only taxable when the dividend is distributed, and secondly, they get no credit for the tax paid by the company. And this, of course, gives rise to these very difficult questions about classification of foreign entities, because the treatment that I've described, in other words, treatment as a dividend, as opposed to just a share of profit, depends entirely on the way that the entity is classified for UK tax purposes by reference to the foreign law. So that's it from me.
Okay, thank you so much, Jonathan. Takes us back to a few years ago when I did the LLM. I've received some comments saying how interesting, by UERJ students saying how interesting it is, the system, and especially the 74 to 99 system, which avoided the internal double taxation. And we identify with you because here in Brazil, we also like complicated legislation. The more complicated, the better. But at least this guarantees our jobs and our seminars and our discussions. So there should be an upside, and we are always studying and being updated. So the bookworms and those who like to debate actually make the most of all these complications. And I would like now to pass to Pablo. Thank him again for joining us. He's going to give us some insights on EU and dividends. So all yours, Pablo. Thank you so much.
Hello. Sorry. Hello. I think you can see me more or less, and I would like to thank again Professor Marcus and the team at the. Sorry, because I'm having issues with the where it went. I don't know. Sorry, I'm having an issue. The seminar has gone, so I don't see you. I hope you can see me.
Yes, we can see you. Don't worry, and we can also see the presentation. Perhaps just if you put full screen, but if not, we can still see it.
Okay.
So anyone is having an issue, please say in the chat and Victor will pass to us.
Okay. So I want to thank all of you, and especially Professor Marcus Livio and my colleagues at this table, Professor Schwartz and Professor Dourado, as well as Doris Can. for the organization, for the invitation, and for letting me to be in this discussion. Basically, my point of view, or my part on this panel, is a broad overview on taxation of dividends in the European Union. Professor Dourado will later take on the part of abuse and the development of abuse regarding dividends in the European Union. So basically, what I'm going to raise is a few issues and questions regarding taxation of dividends in the European Union, just to give a broad picture on the issue. I hope you can see the presentation. Not sure whether it's correct or not. I think you can see it. Is right? Okay. So basically, what I'm going to do is, because of the European Union is an international organization with very specific characteristics. It's not strictly speaking an international organization. It's not strictly speaking a country or a pan-European country. It's a very specific legal system. So, of course, we do not have a unique tax regime, but of course, because of self-integration and because of harmonization regarding some issues, still we do have some common rules regarding taxation of dividends. But as probably most of you know, the European Union still leaves direct taxation at the level, at national level, at the level of the member states, to rule, to define all the rules regarding direct taxation. And this includes, of course, dividends, either at the level of corporate income tax or personal income tax. So because of this, we have a diverse, broad range among all member states, different systems of taxation of dividends that Professor Schwarz already dealt with. The many rules we have dealing with taxation of dividends in each country, in the case of Professor Schwarz regarding the UK, where we can see that in some cases taxes are taxable in a sense, maybe at the level of the corporation. In other cases, taxation at the level of the corporation is an advanced collection that will later be taxed at the level of the second level company, or maybe the persons that are behind once the dividends are distributed. In the end, what I want to say is that we have in each country, we have very different systems. Normally they have a general system in each country, but they have very specific characteristics. So the enormous range of different possibilities of taxing dividends and the relationship of cross-border taxation within the European Union is enormous. Let me get back to explain this, or to get into this, to somehow the basics. So in the end, taxation of dividends is nothing but, to some extent, some say that taxation of dividends, taxation of corporations, and taxation of individuals getting income from profits derived from economic activity from corporations, in the end is a trick of magic to some extent, because you can locate the burden in the different steps. First step regarding a corporation, the second step in another corporation maybe, and in the end in the hands of individuals that are the one that in the end exist in the actual life. So why do we tax that? Because of course, if we legally define that a corporation has a full ability and full rights to deal economically within the market, of course, it has a different ability to pay to those of the shareholders. Again, in no taxation of corporations, we will see some of the different systems may enable to avoid taxes just by putting it on corporations. And it makes easier collection. What I want to say with this is just that sometimes we talk about dividends taxation, and it has a lot to do, as Professor Schwarz made several examples of it, it has a lot to do on the specifics of how that income is taxed at the level of the corporation before it's distributed. Or even in some cases, we just transparent the corporation or the entity and then tax it at the level of the shareholder. So it's important to bear in mind that dividends taxation is a partial part of taxation of economic activity. There are several issues on taxing corporations that impact directly at the taxation of dividends. And one of them is progressivity. We cannot tax progressively corporations. The ability to pay is sometimes difficult to differentiate from the shareholders or from second-level subsidiaries. And the main issue of how the easy creation of different, the give birth, or how we can give birth to different persons through the incorporation of companies and entities enables tax avoidance easily. The main options, and I'm going to go quickly through this, the main options to tax corporations is corporate income tax is a definitive tax, so we pay on that income. What means that on distributions, maybe we are not going to tax it. The economic income derived from the economic activity derived from that corporation is only taxed at the level of the corporation. Another one, as we have been already saying, is that corporate income tax is an advanced tax. So corporate income tax is charged at the level of the corporation, and then credit is given to shareholders. So it's taxed twice, but economical double taxation is eliminated to some extent through credit. In many countries, we do have a combination of corporate income tax and personal income tax, sometimes without credit. And another option is not to tax corporations. In the end, most of you probably already knew these options that we do have. Countries normally have one of these systems, plus they blend it with other, and they establish specific systems such as might be transparency. But what is a dividend? In the end, what I'm saying is locating dividend within a part of the economic cycle of taxing the economic income of corporations. A dividend, generally, broadly speaking, Professor Schwartz already dealt with this also in the UK, is income from shares and similar participations in capital. Others say in a more classical definition is distributions from capital. So we have a broad definition. They may cover several concepts and several different concepts regarding distribution from corporation. We do have normally three levels of definitions within the European Union: the domestic law definitions, the definition at the level of treaties, and in EU law. And these raise several questions because the interaction of them is not always clear. So at the EU level, we will see that the Parent Subsidiary Directive is dealing with distributions. So basically, it's a very broad definition that not exempt from controversy at the courts, tries to cover the broad range of different distributions and income from shares that different member states have in the domestic law. At the treaty level, we have that we know that we have that three-limb definition of dividend that first deals with income from shares in a broad sense, then income from other types of contributions to capital of companies, and then it submits to domestic law, treating at the treaty level the taxation of some income as a dividend if domestically that instruments are treated as a dividend, or similarly to the treatment of dividends within domestic law. As I was saying, within the European Union, we do have 27 countries. That means that we have 27 domestic law systems interacting with respective tax treaties and interacting with the EU law. What means that all those definitions leads to several mismatches. There are several issues also regarding derivatives, coupons, dividend strippings. What EU law is trying to do is to try to provide an umbrella where the different tax systems can coexist and interact each with each other, basically trying to allocate taxation rights and eliminate multiple taxation. So as I was saying, taxation in the European Union is a domestic issue. Being a domestic issue, each member state has a right to tax dividends as they wish, but the European Union specifically deals with the matters regarding harmonization or elimination of barriers to economic activity. That means that, for instance, we have here a clear example of economical double taxation, taxation at the level of company A, and then at the level of the corporation, holding company. This was solved early by domestic participation exemption. So basically, if we did have a holding company in Spain participating in another Spanish company where income was taxed, the income was exempted at the holding company level. The main issue regarding the European Union law was that that problem cannot be solved at that time by domestic law, because if a French company was participating in a Spanish company where the income was taxed once, then when the dividend was distributed to a holding company in France, that was taxed in a second instance. That meant that here I put an example on a 46% taxation of multiple taxation. Basically, this meant that if a company, a French company or a Spanish company, was attempting to invest either in its own country or a different country, normally they were preferring to invest in their own country because they were not subject to multiple taxation. This was why the Parent Subsidiary Directive was enacted in 1990, then subject to recast in 2011, and in 2015 was amended to include an anti-abuse provision. And nowadays we are all discussing why it was put there after the Danish cases. I think Ana Paula will talk about the Danish cases later. The main considerations was the Parent Subsidiary Directive was applicable to one of the entities or two entities that were described in the annex of the directive. Normally the types of entities that recognize as corporations with different personality from the shareholders in the different member states. And they have to be resident in a member state and not resident in a third country according to double tax convention, and subject to tax within the type prescribed in the directive. That means that the company has to be in Spain, for instance, a Sociedad Anónima or Sociedad Limitada, and subject to tax to the specific type of taxes that Spain has declared in that annex in the directive. In this case of Spain, the Impuesto de Sociedades. It is important to bear in mind that here it says subject to tax. What does not necessarily means effectively taxed, and this has been controverted. To apply the directive, the Parent Subsidiary Directive, we need a participation of at least 10% of capital. Usufruct of capital cannot be used as participation for the proposals of the Parent Subsidiary Directive, and we need a participation in a subsidiary. A subsidiary is defined also in the Parent Subsidiary Directive. The main effect, that is what is most important about this, is that in the member state of the subsidiary, there's an exemption of withholding tax. In the parent member state, there's no taxation of income from distributions, or we can include it in the taxable base, giving a credit. And there's no withholding at the member state of the parents. The problem that we have here is that the directive deals with income from distributions to allocate these effects. So income from distributions is normally defined or is going to be highly defined by domestic law. What means that exemptions are not given always within member states to the same concept, because taxable base and the concept of distributions are going to be different among member states. The result in the case we saw before is this one. A company that develops or performs a certain activity in Spain is taxed at 10% in Spain, so it's going to be taxed there, but the withholding tax that Spain may charge is not going to be taxable under it's not going to be charged under the Parent Subsidiary Directive, and the holding company is normally going to exempt the income or include it in the taxable base, and then give a credit on the income, on the tax paid in Spain on that income. The main issues regarding this is that we have different tax bases across Europe. Credit and exemptions are not equal always. we have different concepts of distribution. So there are several asymmetries. These may include, in some cases, dividends. These some include maybe hybrids. But we know that we have a CCTV proposal that has been being discussed around for several years that may solve some of the problems regarding especially the taxable base. Regarding third countries, or within one of the main issues regarding parent subsidiary directives, and this is just to introduce the work of Professor Dourado, is that with as far as we have this exemption within the European Union, there are several asymmetries, but those asymmetries can be taken advantage of by third countries. For instance, if a US company wants to invest in Europe directly in a certain country, it might be taxed on with a withholding tax of 15%. So basically, if we find a country where the withholding tax different from the country where the investment is made, where the withholding tax is 0%, maybe we can try to incorporate an intermediary company there and take advantage of the parent subsidiary directive. In the end, the operative company, the company that is going to perform the business, is going to distribute the dividends to an intermediary company. That in turn is going to pay to the holding company in the US, for instance. So basically, the distribution from the operative company to the intermediary company because of the parent subsidiary directive is not going to be taxed at all, while the Luxembourg company in this case, because of the domestic law of Luxembourg, is not going to be taxed on interest charged to the US. Here we get into the world of abuse. I'm not going to deal extensively with the Danish cases where this was extensively dealt with. You know that the Danish cases are divided into two groups of cases. One deals with the interest on royalties directive, the other one with the parent subsidiary directive. The one with dealing with the parent subsidiary directive deals on a reorganization. I'm not going to go through all the details, but in the end, through setting up an intermediary company, while the first structure, the income was distributed from Denmark, from several subsidiaries in the European Union to Denmark, and from there to Bermuda and the United States, with taxation from Denmark to Bermuda with a withholding tax. They set up an organization where, in the end, the distribution from Denmark was distributed to a Cyprus company using the parent subsidiary directive. That dividend was not taxed at a withholding level in Denmark, was neither taxed in Cyprus, and then it was in turn those revenues paid to Bermuda and then to the US. So the issue here is whether this is abuse or this can be dealt with or tackled through other measures. So the case deals with beneficial ownership. Is surprising because the parent subsidiary directive does not explicitly contain the beneficial owner requirement, but it defines it and it uses it. I always attribute this from the court to a copy-paste because those two rulings were run in parallel. So I think it was just a copy-paste, but the problem is that in the ruling from the Grand Chamber, it said that beneficial owner, it kind of conditionates the application of the parent subsidiary directive. So to me, this is surprising. I don't know, maybe Professor Dourado wants to discuss a little bit on this, but it's not in the parent subsidiary directive. So to my view, cannot be applied, but the court said that is somehow there. The problem again is that the court says that beneficial owner is economic beneficiary, what makes it sort of broad anti-abuse rule, what makes maybe unnecessary to use a principal proposed test as the court also suggests in that case. But what I consider always is whether in some of these organizations, the distribution can be regarded as a distribution or can be requalified. I'm talking about where we use hybrid instruments. Another point that rises to the Danish cases is interaction of directives and the OECD model. The ruling says that we can use the OECD model to some extent to interpret the directives, what means that maybe to definition of distributions, we can also use the OECD model. I do not agree, but maybe this is also a discussion that we can hold. Of course, to me, the interpretation of the Danish cases is not in accordance with the origin of the concept of a beneficial owner. It's not included in the parent subsidiary directive, so it cannot be applied. So even if we can apply it to a parent subsidiary directive, I do not think it should be used in the sense of economic beneficiary. But maybe the solution is to use a broad anti-abundance rule as suggested by the court, and I think Professor Dourado is going to deal with this extensively. So most of the issues I just raised here regarding directive shopping are more questions maybe for the debate, so we can deal with them later. Just for the last issue, to thank all of you for your attention, and to thank again the university and Marcus and the team for the invitation. I'm looking forward to the Professor Dourado presentation and maybe some questions on this.
Okay, so thank you very much, Pablo. Lots of interesting issues that we can debate. A curiosity for the debate is how would this shopping work if we have Brazil as the third country? Because here, even though we have a 0 rate for dividends, in the meantime, we are a very high tax country, and we have extremely strict CFC rules, and there's a debate if they're CFC or not, but they are very strict rules which actually tax the foreign controlled and affiliated companies. So it would be interesting to see how Brazil fits into these corporate organizations. And we're all anxious to hear Professor Ana Paula Dourado, so I'm going to pass to her. Thank you.
Thank you. Thank you for the invitation and congratulations for the initiative. Hello to all the colleagues. It's a pleasure to be here. I'm sharing my screen. Actually, I am trying, before sharing the slides, to share the latest version of the parent subsidiary directive. So just give me some moments. I think I will be able to do it now. And I suppose you can see it, right? Okay, so this is to do some follow-up with Pablo's presentation. So in principle, when the directive was enacted, the purpose was to eliminate economic double taxation. There are some conditions to benefit from the directive that Pablo already mentioned. And then we have had several amendments to the directive. And those amendments, they aim to be in line with the BEPS project, so with the OECD recommendations in the context of the BEPS project. And in this context, we have what we can call a targeted anti-abuse rule, where any abuse of the directive would imply not attributing its benefits, and we may understand as benefits the elimination of economic double taxation. And moreover, we have an anti-hybrid rules that was included in Article 4, paragraph 1A, where the member state of the parent company, when it goes for the exemption possibility, it will exempt to the extent that the profits are not deductible by the subsidiary. So this is all in line with the BEPS project and spirit, as I said, and now we have to combine this with the EU principle of abuse as it was then decided by the court in several cases, and the most relevant cases now will be the Danish cases that Pablo already mentioned. So let me now share the slides with you. And I can start here. This is slide 6, but I will start with this one as also a link to Pablo's presentation. So as Pablo already told us, the Danish cases are related both to the parent subsidiary directive and the interest and royalty directive. What matters to us now is the parent subsidiary directive, but the reasoning of the court in respect of the meaning of abuse was identical in both cases. And there is this reference to beneficial ownership. In other words, according to the court, the benefits from the parent subsidiary directive should not be granted if the dividends are not distributed to the beneficial owners. And as Pablo already told us, this concept of beneficial ownership is not in the parent subsidiary directive, in spite of us having several other anti-abuse rules or rules with some anti-abusive purpose. So what was the reasoning of the court? The court stated that there is a EU principle of abuse, that it is a general principle of abuse, and we can also deduce from the words by the court in the case that the EU principle of abuse is a single principle of abuse. Moreover, the court makes reference to all other fields in general that are covered by this principle, and with this the court aims to affirm that this general EU principle of abuse is not limited, it's not only related to taxes. By stating that there is a EU general principle of abuse, this means that it covers, according to the court, primary and secondary law. What is this? We call primary law to all the rights that are granted by the treaties. In our case, for our purposes, what matters are the fundamental freedoms. And in the case of dividends, it will, in most cases, the situation will, in most cases, be covered by free movement of capital, but it can also be covered by the freedom of establishment. Both are fundamental freedoms under the treaty. Secondary law, in the case of taxes and direct taxes, means directives that are approved by the council. And again, when the court tells us that there is a EU general principle of abuse, it means that it's a single principle covering both the interpretation of the treaties and the interpretation of secondary law. The court further tells us that this general legal principle means that EU law cannot be relied on for abusive or fraudulent ends. Moreover, according to the court, a member state must refuse to grant the benefit of the provisions of EU law where they are relied upon, not with a view to achieving the objectives of those provisions, but with the aim of benefiting from an advantage in EU law, although the conditions for benefiting from the advantage are not fulfilled only formally. Furthermore, in the Danish cases, the court tells us that this EU principle of abuse is not subject to a requirement of transposition of the provisions of a directive into domestic law. Let me now go back to the first slides before I handle this Corfu case and what the court in the Danish cases tells us about Corfu cases. So give me just some moments. Going back. The first relevant case in respect of direct taxes, and that can also be applicable to dividends, was the Cadbury-Schweppes, where the court tells us that a CFC rule implying in the UK a taxation of undistributed dividends by Ireland is a clause that is not compatible with the freedom of establishment in the EU. So what does this mean? A CFC rule to be applied between member states is an obstacle to the exercise of the freedom of establishment. In other words, it's an obstacle to a company, a EU company, to set up a subsidiary in another member state. And therefore, in principle, this CFC rule, that is a specific anti-abuse rule, presumably, is incompatible with the fundamental freedoms. Now, the court, however, accepted that the UK would justify the application of this specific anti-abuse rule in the case of abuse. So what's the methodology that the Court of Justice followed in the Cadbury-Schweppes case? In the first moment, the court compares the treatment that the UK grants to domestic subsidiaries and the treatment that the UK grants to a foreign subsidiary. And what happens is that the UK does not apply and did not apply at the time of the facts a CFC rule to domestic subsidiaries, but it only did so in respect of foreign subsidiaries, controlled foreign companies. Following the methodology that it usually applies, the court then concluded that foreign subsidiaries and domestic subsidiaries are comparable, and therefore a CFC rule is an obstacle, is a restriction to the freedom of establishment. This means to the setting up of the subsidiary in Ireland, and incompatible with the treaty in principle. However, exceptionally, the abuse argument could show up as a justification by the member state, by the UK in the concrete case, to the restriction of the fundamental freedom. So it can justify the restriction. But in order to justify the restriction, this anti-abuse rule needs to be proportionate, needs to comply with the principle of proportionality. What does proportionality mean in this context? It implies that there is an opportunity granted to the taxpayer to demonstrate that there is no abuse, or, well, in general, that there is the possibility to check the concrete case on whether there is abuse. So the court was not conclusive. It was not really conclusive on who did the burden of proof lie, but it concluded that it was necessary to check on a case-by-case basis whether there was abuse. This Cadbury-Schweppes case is also very important until recently, and we can, well, say perhaps until the Danish cases, the recent Danish cases, because it set up a language that was determinant in the analysis of EU abuse. And that is the concept of artificiality or artificial schemes. So for the court and the Cadbury case and the subsequent cases, it was relevant to demonstrate that the exercise of the fundamental freedom was not artificial. That, in other words, it was a genuine exercise. Artificiality and genuine activity show up as two faces of the same coin. And in fact, this characterization of abuse until the recent Danish cases had the effect of being very difficult for a member state in Europe to apply an anti-abuse rule, because artificiality, taking into account the current dematerialized economy, is very difficult to demonstrate. So these are the main topics showing up from the Cadbury-Schweppes that have been characterizing the concept of abuse in the EU for many years. When we come to COFU, we are in face of a directive of secondary law, and it's no longer an issue of applying a fundamental freedom. So in this respect, it's different from the Cadbury-Schweppes. We are not now interpreting the treaties, but interpreting a directive. And under this directive, I'm not going into the facts. You can check them later if you are interested in reading the case. But the thing is that the directive allowed for a neutral regime in respect of restructuring of companies within the EU, so involving member states. And this neutral regime implied a deferral of capital gains taxation. And in the directive, there is a clause, there is a rule according to which the advantages of the directive cannot be invoked if the member state that would apply the directive comes to the conclusion that there is abuse according to its own law. What does this mean, and what did it imply? The way that the COFU case was understood, was interpreted by the tax community in Europe, was that the court did not allow a member state to apply the anti-abuse rule in the directive if the member state did not have a general anti-abuse rule or a similar anti-abuse rule in its own domestic legislation. This is what we could call the absence of direct effect from the directive. What does this mean? Direct effect is a jurisprudential principle. It was set up by the Court of Justice. It means that the EU rules they are they have an effect. They protect the citizens, the beneficiaries of the regime, even if those rules have not been transposed into domestic law. So they are directly applicable. However, as I told you or recalled, under the Corfu case, the court said that the anti-abuse rule in the directive was not directly applicable. Now, I was showing you before this slide in the Danish cases, according to which the court called upon the Corfu case, and it reinterpreted itself. It reinterpreted what it argued, what it wrote in the Corfu case. And now, in the Danish cases, the court tells us the principle of legal certainty precludes directives from being able by themselves to create obligations for individuals, and therefore from being capable of being relied upon per se by the member states as against individuals. So this is Corfu. Notwithstanding what the court held in Corfu, the national authorities and courts are not prevented from refusing to grant the advantage derived from the directives. So now in the Danish cases, the court tells us that in spite of Corfu, the national authorities and the courts can refuse granting the advantage derived from the directives if there is abuse. And what is the basis? It's the general principle of abuse that I showed to you before. So now we have one more specificity in the Danish cases. And it is the following. By claiming that there is a EU general tax principle of abuse or a EU general principle of abuse, the court is also telling us that any anti-abuse rules in the directives are secondary to this general principle of abuse. In other words, if states cannot apply the specific or the targeted anti-abuse rules in the directives, they can still call upon the EU general principle of abuse. Moreover, the court, although it mentions the beneficial ownership without this concept being in the parent subsidiary directive, so it mentions the beneficial ownership concept, but actually it is replacing it. What do I mean for that? Pablo told us and recalled us that, as I just also insisted, the parent subsidiary directive makes no reference to the beneficial ownership concept. However, we know that it is under the OECD Model Convention, and it's part of many bilateral treaties. So what is the court doing here? On the one hand, it's calling upon the OECD Model Convention, in other words, international soft law, to justify interpretation of the facts under the Danish cases. But besides that, it's not really trying to interpret the meaning of beneficial ownership as under the OECD Model Convention, I would say, because it is liaising this concept to the general principle of abuse. So after all, the court is ignoring, it's not really worried about the meaning of beneficial ownership under tax treaties, but it is submitting it, it's using it in order to reassess its general principle of abuse. Let me tell you that this concept of beneficial ownership, it's in the interest royalty directive, and the Danish cases, as I recalled in the beginning, also handle the interest royalties directive. So it's two cases, one targeting the parent subsidiary directive, the dividends, and the other one, the interest and royalties directives. In both cases, the court uses the same language, the same arguments, and in both cases, it uses the beneficial ownership concept in light of the general principle of abuse. On the burden of proof, the court further tells us that the tax authority has to demonstrate that the company is not the beneficial owner, but the tax authority does not have to demonstrate who is the beneficial owner. So as long as the tax authority demonstrates that the company is not the beneficial owner, as long as it demonstrates that, it can tax the dividends, and therefore it will not apply the exemption under the parent subsidiary directive. To conclude, what we have now in the European Union is this single principle of abuse in EU law. Let me tell you that for many years, I have been arguing in this direction, that there is only one single principle of abuse in EU law. The court has been consistently working on it, and now in the Danish cases, it's very clear in telling us that there is only one principle of abuse in EU law. This means that it covers all in our field of taxes, that it covers all type of taxes, direct and indirect taxes, and that it covers harmonized and not harmonized taxes. I would finish by telling you that the court in the Danish cases has replaced this very formal approach that it followed in the Cadbury-Schweppes case, and I described it to you, where abuse showed up as an exception, as a justification. Now, as you heard, under the Danish cases, abuse does not show up any longer as an exception. It shows up as an interpretation that is based on substance, and therefore the court is denying the exercise of the freedoms and the application of the directive in the case that there is only a formal scheme without a correspondence to the substance. And more than that, according to my opinion, this interpretation under the Danish cases, although very controversial, it goes in the direction of the PPT rule under the BEPS project. And therefore, there is here a trend by the Court of Justice of the European Union that is following the BEPS project spirit and direction. So I would stop here. Thank you very much. And of course, happy to participate in the debate and any questions from your side.
Ana Paula, thank you very much. This would be the question that I would like to do about the relationship between the EU principle and the PPT. So we have overlapping, in fact, the time. Unfortunately, I think that it would be really hard for all of us passing the time. So I would ask if Doris wants to do any question for any of our speakers.
So basically, I know we are over time, and thank you all for being here once again. Just a couple of points that I would raise for Ana and for Pablo. Jonathan unfortunately had to leave us to teach at the LLM. But I would be interested to know, as a third country, how the UK is being seen, Ana, from the abuse perspective, if the UK is going to be treated as a, actually for Pablo, if the UK is now going to be treated as a third country from the EU perspective. And for Ana, if planning, if a structure is done involving Brazil, here we have high taxes but zero dividends for the meantime, though there are, as Professor said, bills to tax dividends. Would the tax planning involving dividend remittance from Brazil be considered abuse if the country was used just for this? So these are the 2 points that I leave to you. Again, my apologies for being here over time as well, but they are the curiosities that I have as a Brazilian tax practitioner.
Well, on the Brexit issue, I haven't been following the issue intensively, but as far as concerns the Spanish view, we are not highly concerned because the tax treaty between Spain and the UK highly establishes several measures regarding the taxation of dividends, interest, and royalties that may help to mitigate the Brexit. So basically, we are relying on the treaty. In addition, yes, as far as I know, the UK wants it fully finishes this period. Is going to be a third country. So for the aspect of freedoms, they're not going to be applied in the sense of member states, but on the sense of a third country. However, some rules were included in the agreement reached, and they're still pending some amendments. So I haven't been following the topic in depth, but I haven't seen they have reached any specific agreement on this. I don't know if Ana Paula maybe has more information on the topic.
I think that it's in respect of dividends, they are going to be covered by free movement of capital. So no more information than you, Pablo, in the sense that I don't think that there are any agreements concerning taxes, or I don't think that the directives will apply to the UK, since it was not really a soft Brexit. And therefore, what does this mean? There is settled case law according to which, in the case of dividends, even if there is control, it is to be interpreted as or under free movement of capital. And free movement of capital benefits third states. So it benefits Brazil also. And therefore, all restrictions and all discriminatory measures are forbidden in respect of incoming or outgoing dividends, which means that if Spain grants exemption in outgoing dividends to other member states and domestically, then it shall also extend this exemption to third countries. This means also to the UK in the Brexit situation. Yes, Marcos.
No, please go ahead.
Okay, on the PPT, yes, the main difference I find between the general EU principle of abuse and the PPT relies on the presumption. There is no presumption of abuse in the EU, and that's settled. But otherwise, they are going in the same direction. Also, there is this general anti-abuse rule in the anti-tax avoidance directive that applies to at least corporate income tax, but it will be for sure interpreted also in light of the Danish cases. So we will reach this one single principle of abuse. On your case, Doris, and intermediaries, if the court still keeps its jurisprudence, yes, so the outcome is that intermediaries will no longer benefit from this elimination of economic double taxation under the directive.
Wonderful. I'm really curious to see the application of the PPT between two European countries. This would be really interesting, contrasting the MLI with the European Union directives. And so let's see what's going to happen. Thank you very much. First of all, thank you very much for hosting me in Austria many years ago. At the first time that I went to Austria to study something about taxation, international taxation. Ana Paula, thank you very much for inviting me to participate of European seminars, articles. Thank you very much for everything. So guys, it was a wonderful morning. I think that the students enjoyed so much, and I hope that we can be together as soon as possible, just after this small problem that's affecting all the world. Thank you very much. Have a wonderful day. Doris, thank you very much for organizing the webinar. Thank you very much, students, for attending and making the seminar. I will ask just 20 seconds because the delay caused by the transmission to YouTube, right? And then we can close. 20 seconds. Counting.
It's still on the delay, I think.
All right. All right.